The Treasury needs interest rates down to refinance a lot of debt.
Right.
We have the 10-year Treasuries falling below 3% sometime by early next year. The implication is that there will be a vicious bear market rally in the dollar, which will take the DXY from around 98 to 103. These developments will probably push the gold price down to around 2,800 sometime before mid next year. At some stage, and I don't think it's going to be too far away, as this must have been a large part of the bilateral discussions, is BRICS is going to bring out their own currency. Whatever it's going to be, it will be supported by gold. One interesting sidelight on that is that the Shanghai Gold Exchange is building gold vaults in a few BRICS countries, including, I think, the first one I heard was in Saudi Arabia, so that China can buy oil from Saudi Arabia in their own currency, which there have been parcels done so far, which Saudi has converted into gold in the Shanghai Gold Exchange. But now, having a gold vault in Saudi Arabia to convert the CNY that they don't need into gold. I mean, there is Saudi, I think, in round numbers, there's a trade difference of $20 billion that Saudi has over China. But it's a differential that's narrowing because of the large exports from China to Saudi. So the differential is held in gold, just as for some years that has been the case between Russia and China.
For years, central banks have been quietly shifting their reserves out of U.S. treasuries and into precious metals. Gold and now silver are being prioritized as critical assets, joining copper on the strategic minerals list. This reflects a fundamental mistrust in fiat currencies, especially as debt and deficits balloon worldwide. The pattern is visible in trade relationships. Russia and China, for example, have balanced imbalances with gold rather than paper claims. The shift signals a profound trend. Global monetary systems are edging away from paper-based wealth and back toward tangible resources that can't be inflated away or defaulted on.
Basically, the message that you're getting is that central banks don't want to hold paper assets.
Nope.
That's the big message. And silver going into the critical mineral list, just as copper has been, I mean, tell me if I've already told you the story. It goes back about a decade when I had a friend in Washington. Sorry, rephrase that. I had a friend who used to be an executive director of one of the large international financial organizations in Washington. And one day he said to me, and I'm going back 10 odd years, one day, Simon, there'll be $2. There'll be a domestic dollar that is supported by gold. The offshore dollar will be allowed to find its own level. And our technical associate has the DXY at around 50 in 2028. So in dollar terms, that's a doubling in the gold price.
Behind the scenes, analysts are projecting a dramatic weakening of the dollar by the late 2020s. Some forecasts suggest the dollar index, DXY, could fall toward 50, a historic collapse. That scenario would imply a doubling of gold prices in dollar terms. Meanwhile, Washington faces an urgent need to refinance its towering debt, which requires lower interest rates. A temporary rally in the dollar may push gold down toward $2,800 before mid-2026. Yet insiders believe this correction is orchestrated, designed to give central banks one last chance to accumulate gold before a major revaluation shifts the monetary order.
The Treasury needs interest rates down, refinance a lot of debt.
Right.
We have the 10-year Treasuries falling below 3% sometime by early next year. The implication is that there will be a vicious bear market rally in the dollar, which will take the DXY from around 98 to 103. These developments will probably push the gold price down to around 2,800 sometime before mid next year. Then you will get the next leg of the bull market starting.
I see. Well, why 2,800? I mean, why do you see a correction down on
That's comes out of the work of our technical associate, WaveTrack International.
Economic transitions rarely happen in isolation. They're often accelerated by geopolitical crises. Rumors of European nations considering troop deployments in Ukraine raise the risk of escalation. French insiders even suggest peacekeeping forces could actually draw Europe into open conflict. If war spreads, financial systems will not remain untouched. Capital controls, already whispered about in Europe, could restrict money flows across borders. Given today's interconnected banking networks, such measures would ripple far beyond Europe, triggering global disruptions. History shows that wars often precede monetary resets, and the current geopolitical climate is aligning dangerously with economic fragility.
I think the Treasury wants the gold price down.
Oh, you think so?
I think so.
What about all this talk about revaluing gold and all this other
Yeah,
stuff?
that's the next stage.
So they probably want to accumulate.
They want to buy more gold.
Yeah, they want to accumulate one last time before they make the big announcement.
They want more gold.
I see.
I suspect that earlier on in this, earlier on when Trump became president, I think through the banking system, they were buyers of gold. I think there is a lot of truth in that.
Mm.
You can answer it a slightly different way. If France has peacekeeping troops in Ukraine, naturally the hospitals would have to be prepared to receive casualties.
How should investors navigate this unstable environment? Long-term bets appear risky as paper asset values, stocks, bonds, and even real estate face potential collapse by 2028. If conflicts remain contained, there may still be a strong bull run in equities and industrial commodities through the mid-2020s, fueled by stimulus and liquidity injections. But one wrong move, whether in Ukraine or the Middle East, could abruptly derail markets. Capital controls, liquidity crises, and declining real money supply would deepen recessionary forces already visible in both the U.S. and Europe. The markets are balanced on a razor's edge, where opportunity meets unprecedented risk.
But the truth is, there won't be peacekeeping troops. There'll be war.
Mm.
So I think that rumor has legs to it. And those legs are supported by my friends in France.
Oh, they think the same things as well. And these would be people in the know?
I wouldn't have made the comment if they weren't.
Understood. Message received. So, given everything that we've just talked about, how do you navigate these markets for the next year or so? And what do you do?
You can only forget about long-term investment. We're entering a very fractured world. Long-term investment, either by companies or individuals, be very unwise to make them, because by 2028, we're probably going to go into very deep recession stroke depression, when asset values, paper asset values, paper asset values collapse. But providing there is no escalation of the wars in the Middle East and Ukraine, then we will have bull market in equities and base metals from the middle of next year into 2028.
The world is entering a new monetary era defined by shifting alliances, strategic accumulation of gold, and waning trust in fiat currencies. The BRICS gold-backed initiative may not dethrone the dollar overnight, but it represents the clearest sign yet that the financial order is fracturing. Meanwhile, investors and nations alike must grapple with debt burdens, falling money supply, and the looming risk of global recession. The future may bring temporary rallies, but the long-term trajectory points toward instability. Whether through war, capital restrictions, or monetary resets, the age of paper dominance is nearing its end, and gold is reclaiming its throne.
My fear is that we don't get that far. that the risk of the delusional leaders in the EU3 moving into Ukraine, supported by America selling them equipment, etc., is a very high risk, and in which case you will immediately have capital controls in Europe. What would capital controls mean outside Europe, given the interconnectivity of banks? So it won't just be Europe, it will be global.
Wow.
So what does that mean? It means that instead of having an inflation blow-off, we go straight into recession. Cutting interest rates, throwing liquidity into the markets, will that be sufficient to cause economic growth when you will have all of these issues within the banking system arising from Europe introducing capital controls?
But we don't see this recession, we don't see these capital controls until 2028.
No. You'll see, the risk is you're going to see capital controls before the end of this year. And America is in recession now, and Europe is tipping over. If you look at real money supply is falling. Real money supply, global and in America. And real money supply is probably the best leading indicator to economic activity.